Okay, so over the past couple of months, I posted some analysis on a specific ticker related to oil and gas industry, a Permian Basin Royalty Trust, or PBT. I had planned to update this, and as the OPEC meetings have gone on, I realized that I had the opportunity to maybe make a little longer video explaining how oil prices will be affected and why that plays into my due diligence. But based on every data point that we have at the moment, we're seeing that early 2022, we're going to have an increase in demand and most likely the end of talks and cuts between the OPEC members. Some ideas brought up by some of the leading members of OPEC was that maybe cuts should be extended through the majority of 2022 and to help stabilize oil prices. Now, I'm sure a lot of people that are filling up their tank every week and wondering if gas prices are going to go back to $5 are wondering what stable oil price really means. And that's pretty subjective, but based on overall analysis from the industry, that can vary somewhere around $68 to $75. And so as supply increases, the price would drop, we would cut supply, price goes back up, basically trying to keep that range and keep everyone happy, including U.S. shale. Simple economics of supply and demand, sure, but as we all know, commodities aren't that simple. And with OPEC being the powerhouse that they are, CAPEX being down with most U.S. shale companies, it's hard to say where we will really be at the end of this year. I have a forecast of around $85 average for WTI, but that really doesn't mean we're not going to have some potential peaks above 100, 120, or even an all-time high of 140. That's mostly an outlier, a Cathy, ARK investment, Monte Carlo type situation, but it's really not out of the realm of possibilities with so much uncertainty in the market, a bullish nature in the commodities, and of course, we really don't know the true gap in U.S. shale. So I keep using that word gap, and it's a little hard to explain how difficult it is to value the production value of a U.S. shale company, what their output can really be, how their wells will produce, how gassy they are, the overall cost of well service as the fracking crews come back online. Well service prices have been depressed for many years now. Most of these companies have been hurting, including Halliburton, Schlumberger. And ideally, we're going to want to keep those well service companies suppressed as long as possible to keep the price of oil up and the costs down. However, there's been quite a lot of companies that have reduced their CAPEX since 2018 or even as far back as 2016, are not doing enough drilling, and the output of U.S. shale has declined dramatically, as you can see here. With that in mind, you may look at this chart and see that we don't really do a whole lot of producing outside of two basins, the Permian and the Eagle. The key thing that I focus on is usually the Permian Basin, since I understand that basin the best, have worked and lived in it most of my life, and I get a nice inside look at the actual activity with boots on the ground. Whether that's visiting a customer, speaking to family that work at these companies, and just seeing the overall flow of employees being hired or laid off. So as we look at this chart here, you can see that Texas, Oklahoma, New Mexico pretty much have all of the production value of the whole United States. One of the largest bullish cycles we've seen in the past couple decades was in 2008 when oil ran to about $140. Since then, it dropped off pretty dramatically, having some bull cycles here and there. Some reinvestment, but most of that reinvestment dropped off in 2016. You can see here that a lot of the producers and their CAPEX, how they were spending their money, largest moment they've had in the past few years was in Q3 of 2019. After that, we've had a dramatic drop outside of consolidating in the oil field. I get a lot of questions about consolidation, but really what it comes down to, synergy, such a dumb word, but it really makes a lot of sense, especially when you're working in certain basins. Looking at the Permian, looking at what Pioneer did with Double Point, what they did with Parsley, even though I disagree highly with the daddy CEO buying son CEO's company at the price point that he did. The land, the production value was high, good, in a decent area that allowed them to work adjacent land with their well service providers and to produce a quality output for their shareholders. And output's really important when we're looking at weekly averages, drawdowns in supply, trying to understand where we're going to land on a supply-demand curve and exactly what that means for the price of oil for each quarter or even each weekly basis. The term peak oil gets thrown around a lot. This is considered the maximum amount of reserve available to the market, which creates a supply and demand issue potentially over the next couple of years or decades. But we tend to always find a new basin with another billion barrels. But anytime we're trading any kind of oil-related equity, we want to look at demand and supply balance, how that's affected throughout the past quarters, what the overall outlook is, and remembering that markets are always forward-looking. Without going into too much detail, everything that I've come up with so far is that we're looking at about 2 million barrels per day of drawdown of all supplies worldwide. That can be affected in a lot of different ways, between war, some sort of crisis, COVID outbreak. But there's also other bullish factors to take into account, like supply gaps in shipping, distribution, locking down a pipeline or rail for natural gas so that it can be distributed to power plants that are in need of it in Arizona so that we can power the lack of reserves in California due to their hydropower and drought. Basically, oil and gas is a crazy moving target, and there's a reason why we have such volatility and fluctuation. So before I really get into Permian Basin Royalty Trust, I want to go over some of the developments in oil and gas, the change in rig count, frac spread, the crack spread, overall inventory, global demand, and more importantly, the outlook of oil and gas throughout the next 3 months. Many of you that have been following oil and gas over the past week saw a significant downturn in the price of WTI and Brent. This was due to a lot of factors, including OPEC's expiration of options that ended Friday, inventory reports that came out over the past 3 weeks which showed a flattening of the draw, and then of course the Delta variant scares have put overall demand outlook down for the past few weeks. Anything dealing with COVID and any new variant is almost impossible to predict since we don't know how each individual country will react. Basically, overall, what the global impact of demand will be, but we do know based on other countries' surge, such as the United Kingdom or India, how much impact it had on global demand. As you see here, inventory draw continues as we see demand increase and U.S. shale continuing to not ramp up their overall production. OPEC has been keeping in line with their cuts. They plan to add 4,000 barrels per day back to inventory in September. When you consider the fact that the last bull run in oil and gas, especially in the U.S., was in 2016, this is a really nice number. One thing we always have to watch is the rig count in U.S. shale. As you can see here, the Permian Basin has the majority of the rig count and has increased significantly in 2021. However, if you actually track the recent quarters, it's starting to taper off and we're seeing U.S. shale have a little bit of self-control. Here I'm going to do something a little different and play a recent podcast from Hidden Forces from an expert in the field about oil pricing and certain shale plays.
Oh, yeah. And as my clients know, I was saying through April, May last year, like, look, I think there's an opportunity here in specific well-run energy companies, particularly in the United States, in part because it's a recovery idea. We may have to be very patient. It may take a long, long time for oil to get back anywhere remotely to $50, let alone where it is today. But I think these are solid investments. Mm-hmm. And the other backstory, as you know well, is that the capital destruction across the shale patch in particular through, 2010 through, say, 2017 was absolutely disgraceful. I think the shale patch, if you will, collectively blew through something like $340 billion of investor capital. And there was no discipline, Dimitri, right? It was like, oh, what are we going to do? We're going to dig a hole, then we're going to dig another hole, then we're going to pump it out, then we're going to lever it up, dig more holes. We're just going to dig and pump, dig and pump, dig and pump. And then we're going to keep issuing shares. And then, oops, along come the Saudis in 2014 and 2015 saying, no, you're not. Mm-hmm. You guys are not going to control global oil markets. Have a bit of this. And then they limped through 2015, 2016, 17. And then what happened in 17? You had activist investors arrived, better late than never, at some of the best run shale companies and said, no, you are going to be much more disciplined. And this was well ahead of COVID. You are not going to dig, drill, pump, lever up. You are going to be disciplined. You're going to manage your balance sheet, and you're going to be much more proportionate with your energy and production adventures, which they were. So what we've got now is first stage, and that's like, okay, this is recovering a bit quicker than we thought. Oil comes up, and then OPEC's like, you know what, we're going to keep this OPEC plus thing going for a bit longer, and it's not about restoring balance. It became apparent as we moved through the new year, Dimitri, it wasn't just about OPEC saying, hey, we've got to get back into some kind of equilibrium. It's like, no, we want the price up. We want the price up. Okay, so what's this got to do with ESG? Well, if you've got activist investors on the register of all the surviving shale companies, and you've got activist investors, as we've seen famously on Exxon and others, saying, hey, not only are you going to be disciplined, but you're not going to keep pumping. Well, what does that mean for oil supply?
They all want prices up.
Well, it's not obvious today because oil prices are under a bit of pressure. And then you've got OPEC Plus, which is sort of holding it together and trying to sing kumbaya. And they're like, I don't think they have much interest in lower oil prices, right? And then you have the ESG, probably a bad pun, but the phrase I've been using for 2 years is the ESG tsunami that is washing across economies and financial markets and all sorts of asset classes. And basically, you're not going to get much funding or cheap funding for a new rig, a new hole. Your insurance premiums, if I'm drilling for tar sands in Canada, try renewing an insurance contract cheaply, forget it. And the compound impact of that, I suspect, or I imagine, right, is that over the next few years, even though the world is obsessed with net zero, we might find that the near-term impact of net zero is not to destroy demand. That's obviously the long-term objective, is to eliminate as much as we can demand for fossil fuels. We want to decarbonize, etc. So we get that. But I wonder, Dimitri, if the combination of the factors I've mentioned means that we're actually going to have a pretty severe impact on oil supply over the next few years, which might remarkably continue to be for the benefit of the best run oil companies, and shareholders might similarly benefit as cash flow is returned to them.
The reason I play that for you is to show you the thesis behind Permian Basin Royalty Trust, where their low debt returns are doing exactly what he suggests by creating cash flow to the cash dividend and allowing the investors to reap the benefits of higher oil prices. So looking back at the rig count, overall rig count is still significantly lower than it has been over the past 3 years pre-COVID. As I mentioned in my last video, North American producers are showing better quarterly profits with less revenue. This is overall due to the fact that they're drilling less, producing more as they utilize their overall existing wells that were drilled pre-COVID. Forecasts are still showing that U.S. crude volume will be around 11.5 million barrels in 2022, up about 5% year on year. It's driven mostly by the Permian, 11% year on year, including a 20% year on year growth from private E&P. Private is a little harder to track because of the reporting that we don't have compared to public companies. Frac spread count is now finally letting E&P operators kind of toe the line on crude oil production year on year for 2021. Forward looking, you can now model between 230 to 240 average active spreads in 2022. Easy access plays are starting to wane. Some of the bigger companies have few more DUCs to carry them through the year, but unless rig count starts to pick up, these companies, I suspect, will have to start seeing significant drawdown in their production value with low or muted production growth for the foreseeable future. Since 2012, the U.S. shale has produced a significant amount of overall global oil supply. Without this continued growth, we could see downward trends of about 11.5 to 11.7 million barrels per day. Other key parts of U.S. shale that I'm seeing are just-in-time delivery being affected. This changes the production profiles of many companies where they're not ready to create a new pad, build out any sustainable working inventory, ready to frac. When planning out or trying to run a full-time frac crew, not having all the components readily available puts significant delay on overall production and completion. With all that in mind, I'm not really seeing U.S. shale being a significant factor in global inventory for the next 6 to 9 months. This doesn't put much pressure on OPEC+, but all the major members seem to be in line. This still keeps my thesis that we will see a huge gap early next year, possibly even later this year. We may taper some here, but it seems like supply is still decreasing significantly, and this will put more pressure on the market to increase the price of underlying crude oil and give incentives to some of the U.S. shale companies to start bringing them online. If this doesn't happen in the near future, we could see somewhat of an oil crisis where we're not able to produce enough for the overall demand, and we'll see significant drawdowns. Of course, this is good for the overall price of oil, many producers, E&Ps, and the specific royalty trust that we wanted to analyze here in this video, which is Permian Basin Royalty Trust. Unlike most of U.S. shale, oil, and gas, Permian Basin Royalty Trust has spent a significant amount of money over the past 6 quarters in order to add new production value to their overall output. We have 2 different properties that the royalties are carved out of that pay out the dividend. Currently, the area that has the most production value is the Walldale Ranch, but is also being drilled and worked over in order to add new production. As I've mentioned before in my other videos, the way this works is all debt to the operator is accumulated and removed from the royalty of that property and is not paid out on the cash distribution monthly. As you can see here, we had a significant increase for the 3 months end for the quarter versus 2020, but the royalty trust increase has not been significant due to this debt. 2021 quarter 1, we had a completion of 27 workover and 8 new wells, which had a production value of about 76,000 barrels through new wells and workovers of the 2020 budget. However, 2021 budget has already added 37,000 for the 6 months, and we saw a completion of 22 new wells and 34 workover. As the overall wells continue to be added, we should see a significant amount of new production through the end of the year. Even though oil prices are still slightly suppressed, I expect us to still hit tops at around $85, $90 per barrel and settle back down into the mid 70s to low 70s. With the demand curve putting more pressure and overall supply still being significantly down, if we see these increase in prices, which we only have an average of $59.35 for the quarter on oil and $2.69 for natural gas, this is still significantly lower than current prices. As this debt gets paid down, we would see a large increase in overall revenue that would be paid out on the cash distribution. Currently, we're still sitting at around 2 cents per share, which is significantly low. However, when you compare quarter on quarter versus last year, we saw an $11 million increase in the quarter of overall revenue for the Walldale Ranch. Comparing quarter on quarter, we saw a little more than $5 million revenue increase. This is money that's not being paid out at all from the Walldale properties. Currently, all payments are under $3 million per quarter, where we should see, even at this juncture without the debt, or almost 7 times what we are currently seeing. This would put our cash distribution at about 15 cents per month and should increase the underlying stock price by roughly 5 times, or $25 per share. The question that still remains, because we don't have the exact numbers of production per well when the wells are coming online, how much the wells are producing on average, whether the majority of the production is coming from workover or new wells, which I suspect would be the new wells. But what we do know is that the overall cost basis for Permian Basin for the drilling, the new production, and the overall outlook of the market is still strong. Knowing that they're paying down debt extremely quick with higher prices, higher production, and if they can get enough production online, we should see roughly 60 to 70,000 barrels added per quarter before the end of Q3. The oil price is stabilizing and potentially rising through the end of the year. With the demand increase and the supply draws, we could potentially see, with the increase of production, a $23 to $27 million quarter in overall properties paid towards either the debt or the cash distribution. That amount would pay down all of the debt for the quarter and give some runway for the cash distribution. Since Permian Basin Royalty Trust is a monthly cash distribution payout, we wouldn't have to wait the whole quarter in order to see a significant jump in the overall underlying of the equity. Unfortunately, my price predictions were delayed a bit due to a lot of concerns about the Delta variant. Otherwise, I believe we would be sitting much closer to $85 a barrel, and PBT would be trading well over $7 at this point. I also wanted to take the opportunity to make a couple comparisons of Permian Basin Royalty Trust versus Camber, CEI. It's been mentioned quite a lot across a lot of different Discords and Twitter groups. Mostly just want to look at the overall production value. They don't have the same market cap. CEI is significantly lower market cap than PBT, but in comparison to the actual barrels being produced between the two, CEI has roughly 11 barrels per day being produced versus 2,800 barrels per day coming from PBT. Last reported quarter for PBT was 201,000 barrels of oil and a little over 800,000 metric cubic of natural gas. This compares directly to Camber of 990 barrels for the last reported quarter, which was ending on September 30th, and about 3,500 for natural gas. As you can see, these production numbers for PBT are significantly higher, allowing for that debt that I've mentioned to be paid down relatively fast. One thing to also note here is that PBT's average per barrel is about $60 versus the $46 of CEI. A recent report of the 8K from PBT in June outlined a lot of their production for the next year and when the debt possibly could be paid down. But due to the Securities Exchange rules for how they adjust the price of oil, they take the last 12 months and get an average, which that average is actually about $39 per barrel, which is a lot lower than what we've seen over the past couple months. So those projections aren't exactly in line with real world numbers.